Hello, welcome to Principles of Corporate Finance class. Through this video series, we will cover all main topics in corporate finance class. Actually, this is Principles Fundamental class. I am Fuzuli Assistant Professor of Finance at Westerfield University Finance Department. So we will start with introduction today. Then at next class, we'll go into financial statement, then time value of money and other. Through this series, we will, as I said, we'll try to cover all core topics in corporate finance. That's why we call it principles. So in general, we assume that you are all have taken accounting or principles of accounting classes, that you are all familiar with basic accounting principles like assets, liabilities, income statement and other. We'll go through these topics in general, but you should be familiar with these topics. So what is finance? In general, finance is management of sources, financial sources. In general, acquiring funds and using funds. How to acquire funds at cheapest cost, how to use funds at highest profit. These areas of finance are corporate finance, that's business finance, public finance, international finance, and other investments. We are here at corporate finance, that's business finance, financial management of companies. Assume that you are starting a company. You are starting any type of company in any financial or in economic area. First, you need to talk about what will you do, what products will you produce and sell. It requires some fixed assets. In financial terms, what fixed asset you should invest in. Let's assume that you are starting your restaurant business. You are planning to open a new restaurant. So first you think about where to open this restaurant, where that will attract new customers. You need to find the land, that's property, and you need to find, you need to buy some equipment, that's cooking equipment, cooking wares. So this is all these are your fixed assets. It means that you need to find fixed assets. In terms of finance, that's your investment. So assume that you have decided to start your business. You have business plan, everything is okay. The second topic in your mind is how to finance these assets. You have found the land, you have found cookwares and others. So you need money, you need financial sources to buy or to rent this land or to buy these cookwares. So here we come to second function of finance in corporate finance. How to finance your investment. And you also you bring your friends together. These are your owners, the shareholders, and you start your business. You found your land, you found sources, start business. Also, you need to manage your day-to-day operations. So to sum up all these steps, we build functions of financial management. As first one, corporate finance tries to answer what long-term investment should company take on. As I said, you are starting your restaurant business. It means that you are making a long-term investment. So you have decided to start your restaurant business. This is your long-term investment on land and cookwares and others. It also lines of business will the firm be in and what plant, property and equipment will it need. Where will the firm get long-term financing to pay for the investment? This is where will you get funds. As I said, you can bring in your new owners, your friends, or you can issue shares and others, or you can easily go to bank and borrow money. And how will company manage everyday, day-to-day, daily financial activities? Starting your restaurant business, you buy raw materials. These are vegetables, fruits, and other food. So buying your food, you are creating accounts payable in your balance sheet. That's buying your food. You don't pay cash to your suppliers in general. And at the same time, let's assume you're also doing catering business. You sell to other businesses, and other corporations will pay you at the end of, let's say, month. So you also have receivables on your balance sheet. How to manage these receivables and these payables? This is also function of financial management, because all excess of these receivables creates cost for company. At the same time, also shortage of these receivables may create cost for company. If you put these functions on balance sheet, we can say that first function, we call it capital budgeting. What long-term assets should company invest in? This comes to investment on fixed assets, as I said, on your balance sheet, on the company's balance sheet. So this function is called capital budgeting. How to finance these fixed assets comes from sources may come from liabilities or equity. So how should the firm raise funds for the selected investment? These investments, it is our second function. Second function of financial management. We call this capital structure. Also, as I said, company has daily, day-to-day operations. These operations are maintained through current assets and current liabilities. So, and these can be shown as net working capital. This is the difference between current assets and current liabilities. So, to sum up, functions of financial management, this is important, an introduction on today's session, first session. Functions of financial management are long-term assets should the company take on. This is capital budgeting. How to finance these investments, capital structure, and how should current assets be managed and financed. This is management of working capital. In a company, these functions are operated through finance managers. So three main financial concerns are usually handled by the top officer and his or her assistants. First one is vice president or CFO, chief financial officer. This is the top finance position in a typical company. Strategist, coordinator, authority, they are main authority to make decisions on financial issues. So there are the treasurer, cash flow, capital expenditures, and capital structure controllers. This may change from company to company, but in general there are these type of financial positions. A hypothetical organization chart starts with board of directors. That's the toppest institution in the management of company. These are shareholders, let's say main shareholders come together and form board of directors. They appoint a CEO, chief executive officer, that this manager acts on behalf of shareholders, on best interest of shareholders. So there are the president, chief operations officers, and others. So board of directors are, as I said, are the main, let's say, a legislative body of company. They make decisions how the company will operate in general operation lines. Also, in an introduction, we should talk about forms of corporations, forms of business, because it acts how these functions are met. So far we talked. Sole proprietorship, this is the basic form of business. That's if you want to start a business, you can only go to, let's say, tax authority with your ID, very simply in Azerbaijan with your shakhsiyat vesigasi. You go to tax authority, open your tax account and start your business. This is sole proprietorship, the basic form of business. So in this type of business, you are responsible for all your actions. The partnership, we put it into two sub-categories, general partnership and limited partnership. You don't want to work by your own because you take all the risks. You bring your partners together and form a partnership. So general and limited partnership, this is due to responsibilities, how responsibilities are separated. And the corporation. Corporations are the wider categories. These are companies come together. They not only limited to partners. The corporations issue shares to public. They have publicly traded stocks, and there is not one shareholder or two shareholders in this type of companies. So what we talk here through these courses is based on corporations, unless others stated. So these are their comparison between partnership and corporation, liquidity and marketability. Corporations can easily be exchanged. They have outstanding shares, and it's very easy for corporations to raise funds and to attract new funds. Voting rights, usually each share gets one vote, but in general partnership, general partner is in charge. Limited partners may have some voting rights. This is somehow limited. Taxation, double corporation. Corporations have double taxation. Partnerships may tax on distributions. This is actually main disadvantage of corporations. So corporations pay income tax on their own as a company. So they pay once income tax to government. They have net income. Net income is distributed among shareholders. Shareholders get dividends. Shareholders also pay dividend tax. So what shareholders get is double taxes on corporations. Reinvestment and dividend payout, it's broad latitude. All net cash flow is distributed to partners in partnership, but in corporations, as I said, there are many shareholders and debt holders. All the cash are distributed among them. Liability, it has a limited liability, but in partnership it's somehow different. Corporations, they have perpetual life, but partnership has limited life. So this is general comparison. Companies may be in one of these types or others. Corporate form of organization is not unique to the United States. As I said, it may change from country to country. There are limited liability corporations, PLC, and others. So again, coming back to financial management, I talked about functions of financial management. We said 3 functions. Also, we can add dividend payout policy as the fourth function of financial management, because corporations generally pay out to their shareholders, or they may not pay out. Also, this is a policy of company. But the main goal of financial management is not maximizing profit. Main goal. Functions are different than goals. Maximizing profit is very important, but maximizing profit, for example, to maximize profit this year, company may have higher sales, as for example they sell on discount to get higher sales, or they may make some change on costs and have higher profit, but this may not be sustainable. That's not to say that the main goal is not maximizing profit, because it is easy, it is open to manipulation. Minimize costs now. Maximizing market share now, because market share, having higher market share, it's a good goal, it's an important, or it may be a goal of marketing department, but it's not goal of financial management. Maximizing shareholder wealth, yes, because maximizing shareholder wealth means maximizing firm value. That's very important. Having a higher firm value means equity holders, shareholders have higher wealth in company. So that's why companies say that we are trying to increase your wealth. That sounds very good to favor shareholders. So, and coming to, as I said here, company board of directors come together. They appoint chief executive officer to act to manage company on behalf of shareholders. Sometimes those managers act not on the best interest of shareholders. They act on best interest of themselves. That's agency problem. Shareholders, that's the real owners of company. They may have other jobs as well. So they appoint one manager to work for them. They are not aware of full procedures for operations in company. But company managers knows everything what's happening in company, what opportunities rise, what's best for company. Sometimes they hide better options for company and put forward what's best for them. Shareholders may not see these options, but company managers see these options and they manipulate it for their own interest to get higher bonuses, for example, to get hired for long term. But this happens as, for example, there is a project for a company that's very profitable. In 10 years, for example. That's a long-term project, and there's another alternative project that's also profitable but in short time. So managers may hide this long-term project and may show the short project, which is best for them. They will get higher bonuses if this project is selected, and they will be hired for some period. So if a company chose this project, let's say in 10 years, after 5 years, company would get higher profits. But the manager may think that if I will be here for 10 years, after 5 years or not, so I shouldn't go with this project. They choose the best one. What is lost here is agency cost for company. That we call this agency cost for company. So there's an example: large investment positions firm for long term, as I said, positive cash flow, but has risk in short run. Owners want this investment, increase firm value. Managers' objectives may have personal costs. If they accept this project, these risks may have some personal cost to them. If managers prevail, for again, long-term cash flow is the agency cost, as I said. There are many ways to solve this agency problem, but it is not solvable at all because there is a human factor. So they have some interest for their own. But there's a way to mitigate them. As companies apply, they put some compensation systems, bonus systems for managers to motivate them to act, increase company value, share value. Coming back to second function that we call capital structure. So how companies raise cash? They do this through financial markets. Corporations are in one side, and financial institutions are in other side. So there may also be some individuals come and invest in investment funds, financial markets. Cash is collected here. They have, let's say, cash surplus, they have excess cash, and corporations need cash. They have cash shortage. So they come together and meet at financial markets. The individuals lend money or invest in company. They very simply, they give their money to corporations through buying stocks or bonds, securities, bonds or stocks, invest in company, and they produce, they make productions, and they create new value, add value, generate higher positive net income, and they pay out to these companies, these investment funds. So this process, all this process happen on financial markets. Financial, as it's seen here, financial market is a place where those in need for cash and where they have cash surplus come together and exchange their cash. Financial markets are very developed nowadays in modern world. There is very less physical market of financial markets. Almost all transactions happen on online regime. We divide financial markets into primary markets and secondary markets. Primary market is where transactions happen between company and investor. That's primary. First, company issues stocks to investors, and that investors buy stock from company, from main issuer. These actions happen on primary market. Secondary market is where stocks and bonds traded between investors. That's not one investor may buy stock from another investor, not from principal company. Also, we divide financial market into, again, talking about financial markets, divide into capital markets and money markets. Capital markets are the markets where long-term securities are traded, long-term financial assets are traded. These are bonds, so at least they have maturity of 1 year or having maturity over 1 year, more than 1 year. Stocks, these are mainly unlimited, they have perpetual life, and others, let's say derivatives. So all these assets, long-term assets, are traded on capital markets, or capital markets are for investment horizon over than 1 year. Money markets are the markets where short-term assets are traded. Short-term, we mean with maturity up to 1 year, until 1 year. These are, so here are traded treasury bills, mainly treasury bills of government, US treasury and other government treasury bills, commercial papers, that's short-term papers, borrowing of company, commercial papers, certificate of deposits and others, repo and other actions. All these securities have maturity less than 1 year. Maybe there are 30 days commercial papers, 90 days treasury bills and others. Very short term, 1 week repo actions, operations and others. So if company needs cash at short term, they can easily go and borrow at money market. Or if company has cash shortage, cash surplus at short term, for example, they have cash more than they need, for example, for 3 months, they can easily go and invest in treasury bills. But if companies need long-term financing, they go to capital markets. Also a few words about working capital management. That was third function of financial management, working capital management. As I show on our slide, we have current assets. current assets as cash, accounts receivables, inventory, and others. And we have current liabilities. Let's build T-shape balance sheet. Current liabilities. We have accounts payables, notes payables, lease payables, interest payables, and tax payables, and others. Wages and others. So working capital management, as I said, is day-to-day management of these assets, current assets and current liabilities. For example, management of cash, that's important. Cash management, we will talk in details in coming weeks. How much cash should company have? Holding excess cash more than needed cash has opportunity cost. Or having less cash, shortage of cash also creates cost. Lost, for example, very simply, lost opportunities. There may be sudden recent opportunities. If you have cash, you should buy it, for example, as a company. And also receivables. Accounts receivables are also important managing accounts receivables. So having higher receivables is actually a bad sign for a company. It means that you have sold so much, very huge numbers, but you haven't collected cash. Having less receivables also may create cost for company. It means that you are trying to sell everything on cash. You may lose your customers. Same logic applies for inventory as well. Having higher amount of inventory may create cost company as storage costs, warehouse costs, and others. Having less inventory also may create cost company as you need to reorder again and again and again. So ordering may have transport costs and other costs. So we'll talk about managing these current assets, that's maintaining optimum level of these assets in terms of cash money. Also in liability side, we'll try to have try to find optimum level of payables, because actually we want to have higher payables. This is cash source, but if we pay late, very simply suppliers will not sell us, or we'll lose some opportunities. Same logic applies for notes payable and others. If we don't pay taxes, we may get fined. So this is introduction to financial management. That is functions of financial management. What will we talk about through this series? This is session 1, introduction, and also we talked about financial markets very shortly. Where companies find sources. We say that one function of financial management is finding sources. Where we find source, we need to go to financial markets. That's all for introduction. We'll continue with session 2 next time. Thank you.